Hello, and welcome to the Deliberate Dollar. Pull out your homeowner's declaration page, the one your insurer mailed you at renewal. The single number at the top is the dwelling limit, the number you remember. Now look at the second half of that document, the exclusions, the sublimits, the endorsements you don't have. That's the policy you actually own. It's a very different policy than the one they think they own. I want to talk to you about your home insurance policy. I am not a financial legal person, you must consult an insurance agent that's licensed. This video is for informational purposes only. We do gather information from publicly available data for our resources. And in the description, you'll find some nice tools for you to use for free. So, why this matters, you looking at your home insurance policy annually. Here's the strange part. The national average homeowner's premium in 2026 is roughly $2,490 a year, about $208 a month for $400,000 of dwelling coverage. That's a real number, and it's already higher than a lot of people remember. But the premium isn't the financial risk. The financial risk is the gap between what you assume your policy covers and what the contract actually pays out for a single uncovered claim can dwarf a decade of premiums. I'm going to walk you through 8 gaps, and I need you to pay attention and follow along. Gap number 1. Almost every homeowner gets it wrong, and that's flood insurance. Most people assume their policy covers water damage, so it must cover flooding. It doesn't. Standard homeowners and renters insurance excludes flood damage entirely across the entire market. Flood is sold separately, either through the federal government's National Flood Insurance Program or through a private flood insurer. The NFIP caps out at about $250K for the structure and $100,000 for personal possessions. And there's a 30-day waiting period before the coverage takes effect. So you can't buy it once a storm is on the radar. Talk to a licensed insurance agent in your state about private flood policy that fits your situation. Also, the second gap, water from the bottom up. The standard policy makes a quiet distinction. Water from the top down, like a burst pipe inside a wall or rain through a damaged roof, is covered. Water from the bottom up, sewer backup, drain backup, sump pump failure, or ground seepage is excluded by default. And the sewer lateral running from your house to the city, in most jurisdictions, the homeowner owns that line, including the part under the public street. The fix is a separate endorsement on your existing policy, usually called a water backup or sewer backup endorsement. Coverage limits may vary. Talk to a licensed insurance agent in your state about adding a sewer backup endorsement and how much that costs. The third gap, earth movement. So, something like earthquakes, sinkholes, mudslide caused by a quake. Homeowners and renters insurance excludes all of it. Your policy will pay for a fire that follows a quake and the cost of living somewhere else if that fire makes the home unlivable But the earthquake damage itself, no. And it's not just a California question anymore. Specifically, there are flags rising earthquake activity in places like Oklahoma, and you need to look at your coverage and endorsement policies. And the deductibles are typically a percentage of your dwelling coverage, not a flat dollar amount, much higher than people expect. Talk to a licensed insurance agent in your state about whether earthquake coverage makes sense for where you live. Gap number 4. This is the one that ambushes owners of older homes. If your house is destroyed and you have to rebuild it, current building code might require things that weren't required when the house was originally built. Hurricane straps, upgraded electrical, ADA features, elevation on stilts for coastal properties. The standard policy will not pay the difference between rebuilding as it was and rebuilding to current code. For an older home, that gap can run into tens of thousands of dollars out of pocket. The fix has a name, an ordinance or law endorsement. Talk to an insurance agent in your state about adding ordinance or law coverage, especially if your home is more than 20 years old. Gap number 5, replacement cost versus actual cash value. This is the single biggest reason homeowners feel cheated after a claim. There are 2 ways a policy pays out: replacement cost or actual cash value. Actual cash value is a replacement cost minus depreciation. So a 15-year-old roof gets paid out at the depreciated value of 15-year-old roof, not the cost of a new one. The insurer isn't cheating you. It's the form you bought. Confirm the dwelling is on replacement costs in writing. Ask the same question about your personal property. And in high-risk areas, ask about extended or guaranteed replacement costs, which gives you a buffer over the dwelling limit if construction costs spike during a rebuild. Talk to a licensed insurance agent in your state and ask specifically, is my dwelling on replacement costs or actual cash value? And what about my personal property? Gap number 6, jewelry and high-value items. This is the sub-limit trap. Your declaration page might say personal property is covered up to 200,000 K. What it doesn't say at that level is that inside that coverage, there's a special sublimit for theft of jewelry, watches, and furs, typically 1,000 to 2,000 total, not per item. It's total. A $6,000 engagement ring stolen with the rest of the contents reimburses at the sublimit, not the appraisal. 2 fixes: raise the sublimit, which is cheaper but still capped, or schedule the items individually on a personal property floater with current appraisals on file. Floaters are typically covered under accidental loss. Dropping a ring down the drain, leaving a watch in a hotel, which the standard policy does not. Talk to a licensed insurance agent in your state about scheduling individual valuables and get them professionally appraised first. Gap 7, mold. Mold is generally treated by the standard policy as a maintenance issue, alongside rot and insect infestation, and excluded. So the narrow exception is mold that's a direct result of a covered peril, like a burst supply line, mold from a slow leak, from humidity, from a long undetected drip, are excluded. And remediation for a serious infestation can run into the tens of thousands. Some insurers offer limited mold endorsements with capped limits, so ask. Beyond that, mold is a prevention problem. Indoor humidity in the 30 to 60% range. Fix leaks fast. Dry water damaged areas within 20 to 48 hours. Talk to a licensed insurance agent in your state about whether your policy offers a mold endorsement. Gap number 8, dog bites. Well, this last gap, and it's heavier than people expect. Homeowners liability typically covers dog bites due to legal expenses that can add up to the liability limit, usually $100,000 to $300,000. And if a claim exceeds that limit, the dog owner is personally responsible for the excess. The 2025 numbers: dog bite and dog-related injury liability claims cost U.S. homeowner insurers $1.862 billion last year. The national average cost of claims was $65,000. The claim went up $28,000 in 2025 versus 2024. So, some insurers won't insure homeowners who own certain breeds. After a first bite, many insurers will not renew the policy, exclude the dog from the future coverage, or raise the premium. Rules vary by state and by carrier. 3 steps. Confirm your liability limit is high enough for your asset base. Ask your insurers in advance whether specific dog breed is excluded or surcharged. And if you have a significant home equity or other assets, ask about an umbrella policy. Talk to a licensed insurance agent in your state about your liability limits, breed coverage, and whether an umbrella policy makes sense for your situation. So, 8 gaps is a lot. Here's the short version for you. 5 questions. Your declaration page in front of you, about 10 minutes. 1, do I have a separate flood policy? If you don't see one on the page, you don't have flooded coverage. It's never bundled into a standard policy. 2, is my dwelling on replacement costs or actual cash value? Find the phrase under coverage A. If it says ACV, depreciation will be deducted from any claim. Number 3, what's the special sublimit for theft of jewelry, watches, and furs? It's under special limits of liability on the personal property page. Anything above that limit needs a scheduled floater. 4, do I have water backup or sewer backup coverage? It isn't an endorsement. If it isn't listed by name, you don't have it. 5, do I have an ordinance or law endorsement? Look for it by name in the endorsement section. Without it, you're paying out of pocket for code upgrades during a rebuild. If you didn't know the answer to one of those, that's not a failure. That's the gap you take to your agent. Once a year, before you auto pay the renewal, run through 7 items. Check the rebuild cost again, current local construction prices, confirm replacement costs, both dwelling and personal property. Refresh your home inventory. A video walkthrough is enough. Audit the high value items. Run the 5-question gap audit you just heard. Check your liability limit against your asset base. And get at least 2 competing quotes. Don't renew on autopilot. That's an hour once a year. It's the single highest leverage thing you can do with your homeowner's policy. Call to action. Make sure that you check out a free companion guide for this episode. The Homeowners Coverage Audit Gap is a PDF printable with 7 questions and a web-page checklist you could bring to your renewal, and the full sources list. No emails are required. The link is in the description. If this was useful for you, subscribe, hit like at the bottom, and that's how this channel grows. Money on purpose. Thank you for attending, and we'll see you next week. This is the Deliberate Dollar.